Welcome everyone to the Vested Interest channel. This is Shane back for a stock pick of the day video. We're going to take a look at one out of the financial sector. This is Kinsale Capital Group. It's an insurance company. Now this is the Vested Interest stock screener. This is the criteria we will be running through today. And since it is out of the financial sector, we will be looking at price to book. So it must meet 6 of 9 to make it onto my watch list. This is just an initial screener, so even if it does make it through, it does not mean I am buying. It just means it goes on my watch list, and then I want to do more of a deep dive into the financials of the company, looking at their balance sheet, their income statement, doing a discounted cash flow analysis on the company, figure out a range I'm willing to pay, and then possibly adding it in the future. But even if I was buying the stock, you should not be blindly copying anyone else that you see on YouTube or anywhere else that you may be visiting as far as sites that you go on. Make sure you're investing based on your investing strategy, your criteria that you've put together, your timeline to retirement, and what your overall goals are. All right, back to Kinsale Capital Group. You can check them out on their homepage, www.kinsalecapitalgroup.com. That's www.kinsalecapitalgroup.com. That is their homepage where I pulled this information from. Our business, Kinsale Capital Group Incorporated, is a specialty insurance group focused exclusively on the excess and surplus lines market in the United States. We use our underwriting expertise to offer terms to hard-to-place risks. Our goal is to provide long-term value to our stockholders by generating exceptional profit and growth. Kinsale seeks to accomplish our goal by producing consistent underwriting profit, steady investment returns, along with sound capital management. And you can read the rest of that if you like. But really, they're an insurance company, right? So they've got two different arms here. Kinsale Insurance Company. Kinsale Insurance Company, Inc. is domestic excess and surplus lines insurance company specializing in hard-to-place property, casualty, and specialty risks. All products are distributed through select surplus lines brokers throughout the United States. The company targets small to medium-sized accounts and can offer terms on a variety of risks to include those with new or high-hazard operations and businesses that have poor loss histories or are located in high-risk venues. Kinsale is eligible in all 50 states, the District of Columbia, Puerto Rico, the U.S. Virgin Islands, and you can read the rest of that as well. And then Aspera Insurance Services acts as an underwriting manager for personal lines of risk. Aspera Underwriter manufacturing homes using its proprietary web portal. So they are really insuring the things that most insurance companies that don't want to, manufacture at home, for example. They're built different. They have higher risks. They deteriorate faster than a regular home. So that would be, probably not something that every insurance company is wanting to take on. And then when you talk about surplus lines insurance companies, hard to place property. So if you had, let's say your home, you can get home insurance, but then if you wanted to insure a significant amount of jewelry you had, maybe you're a sneakerhead and you've got thousands of dollars in sneakers you want to try to insure, you'd probably go to a company like Kinsale or Kinsale themselves to insure that additional property on top of your regular home insurance. Now, the reason we're taking a look at them, down today 0.34%. We are talking about Kinsale Capital Group, ticker KNSL, out of the financial sector. Close out the day at $374.49. 52-week range as low as $363.14, as high as $531.79. They are within 15% of that 52-week low currently. Market cap of 8.726 billion, beta of 0.95, so just slightly less volatile than the overall market. PE, price to earnings ratio, at $18.38 per share. Price to book is more of a metric you want to use for companies like this, insurance companies, banks specifically. We'll look at that here in a second. Earnings per share at $20.37 per share. Earnings date was back October 23rd, so you can go check that out if you're interested. Forward dividend, 0.68 cents, so 68 cents, which gives them a very, very low starting dividend yield of 0.18%. Ex-dividend date was November 28th. Looks like they're going to pay out on the 11th. You would not get the next dividend payout on the 11th if you were to buy them today. You'll have to wait several months to get it. You want to be buying at least a day before the ex-dividend date, so November 27th and before. If you bought it then, you'll get that next dividend. One-year target estimate of $465.30, which is upside from here, according to Yahoo Finance, but not quite back to their 52-week high. Again, this information is from Yahoo Finance. I am not affiliated with Yahoo Finance. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. To do that, we take a look at their 5-year dividend yield average, 0.17%, compared to the current 0.18%, over here forward 0.18%, same number. Since it is ever so slightly higher than their 5-year average, this does speak to potential undervaluation, though really, leaning towards that fair value slightly, ever so slightly, a hair maybe undervalued right now. At least, again, according to dividend yield theory. Now, their payout ratio is extremely small, 3.24%. So they are paying out, even though their dividend is very small, their payout ratio is extremely small as well. So this gives them a lot of room to increase that dividend over time. And for insurance companies, that's what you want to see, nice, steady dividend growth over time. Now, free cash flow, let's go to price to book real quick. Now, typically under 1 is what you want for banks and companies in the financial sector, but I never seem to see it really outside of banks. So I use it specifically for banks. But one of the things I do like to use price to book for even insurance companies like this, even though they're not under 1 here, if you can see here, going back September 2024, they were at 8.62, lower at 7.4 or 7.54 in December of 2024. March of 2025, 7.65. June of 2025, 7.12. Starting to get cheaper there. It's September of 2025 to 5.74. But look at them right now. 4.69 puts them cheaper than they have been going, and significantly cheaper than going all the way back to September of 2024. So over a year ago, year and what, 3 or 4 months, 2 months, 3 months, year a little over a year ago, back to September 2024 at 8.62 to current 4.69 means, according to price to book, they have gotten much, much cheaper. Free cash flow, you can see here, December 2021, 401 million, 2022, 550 million, 2023, 853 million, 2024, 952. Looks like they're trailing 12 months, 961. So you are seeing nice, steady free cash flow growth. That is what you want to see. Very nice. Repurchase of shares, looks like last year they pulled out 10 million. At trailing 12 months, they've increased that 49.9 million. So pulling shares out of the market, growing free cash flow. Price to book says they're the cheapest they've been in a while, and dividend yield theory says they're potentially slightly undervalued right now. Jumping over to stockanalysis.com, another source I go to. I do recommend 2 sources for you as well, 2 if not 3, so you can make sure the information you are looking at is accurate and up to date. I would not solely trust just one source. That's just my opinion. You do what you want and pick any sources that you want. Now, 9 analysts have taken a look at this over at stockanalysis.com. They call it a consensus buy, though it is right on the edge of a hold and a buy. If you were to go to the website, you could see how many might call it a strong sell, a hold, a buy, and a strong buy. Right just over into the green. Buy is the consensus from the 9. Low estimate of $415 would represent a 10.85% increase from where it currently sits. Average estimate of $483.78 would represent a potential 29.23% increase. And if it happened to hit their high estimate of $560, that would represent a 49.58% increase from where it currently sits. And you could collect that, 0.18% dividend yield along the way. Now, I like to look at a couple statistics as part of the initial screener, and that's return on capital employed and earnings per share growth. Return on capital employed, I like above 10%. They're at 29.42%, almost 3 times the 10%. I like earnings or above. Earnings per share growth, I like 5% or above over the next 5 years. They did not have anything listed, didn't have anything listed for revenue growth either. Quarterly pay, as we mentioned, payout ratio extremely low, 3.34%. Now this is what you want to see, 13.33% dividend growth, very low payout ratio. They have a long runway, can continue to really push this dividend growth of 13.33% for the foreseeable future and not be in any danger of being a dividend cut being on the books at all. So if they continue this dividend growth of 13.33%, that is awesome. Growth of 9 years so far. Buyback yield is positive at 0.14%, so they are pulling more shares out of the market than they are issuing. Shareholder yield is positive at 0.32%. They do pay, like most companies, on the March, June, September, December timeframe. Going back in time here, May 2023, you can see 14 cents per share per quarter. February, they jumped that up to 15 cents. And most recent raise was February 2025, 17 cents. So nice dividend growth here, 13.33%. 2 pennies there was the last one, but very low payout ratio as well. This one is an interesting company, might be worth a look if you're looking for something in the financial sector. All right, let's run through the screener. So understand the business. Yes, they're an insurance company. Now they're, insuring things that are harder to insure, like special property, stuff like that. Manufactured homes, a lot of companies don't want to deal with because, like I said, they are built different. They don't last as long. But they get a check. They're an insurance company. Growing free cash flow. Yes, they get a check there. Nice, steady free cash flow growth. Growing dividend. Yes, double-digit dividend growth. Like to see that. Payout ratio extremely low, under 5%. Check there. Dividend yield theory says they're potentially undervalued just ever so slightly, so they get a check there. It is within 15% of a 52-week low, so check there. Return on capital employed is above 10%, so check there. It was at 29, just above 29%. Earnings per share growth was the only one that they didn't have there. Price to book as well. So they didn't have the bottom two. Price to book, they were not under one, but they are the lowest they've been since at least September of 2024, and they did not have anything listed for their earnings per share growth over the next 5 years. So they get 1, 2, 3, 4, 5, 6, 7 out of 9. It is going to slide on my watch list. It's not one I've done a deep dive on yet, but definitely will. What do you think of this company? Kinsale Capital Group. Let me know in the comment section down below. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. And with that said, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, let me know what's going on with this one in your opinion. Kinsale Capital Group. Buy, hold, sell. Is it one maybe you were dumping today? And let me know if you were. Would love to hear from you. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion in just investing journey for educational and entertainment purposes. Investing involves risk. You can lose money, so never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria. Or seek the advice and counsel of a certified financial advisor.